Hello, fellow Rebel Capitals. Hope you're well. So we got a new format today. We're going to go over three major stories from today. The first off is going to be the takeoff of the United States dollar. It is going parabolic. So we've got to figure out what is happening with the USD relative to other fiat currencies. And then what does this mean not only for the United States, but maybe even more importantly, for the global economy. Remember, there's a lot of dollar-based debt out there, and a lot of countries like Japan require dollars to buy the stuff they need, such as commodities, to produce the stuff that they need to keep the economy afloat to the degree to which it's still floating and not tanking. So let's get into the dollar exploding higher first and foremost. Then we're going to go over two other stories that I think you're going to find fascinating. So buckle up, sit down. It's going to be about an hour-long live stream, and you guys are going to love it. So first, let's go over to a chart of the DXY. We're going to go over to Market Watch here, and you can see that we're almost up to 107. So for those of you who are maybe new to the channel, you'd say, okay, George, that doesn't mean anything to me. Give me some context. So let's go back 3 years on this chart. And you can see that we were only at a point higher in 2022. And this is when the Fed was really starting to increase interest rates. So you had massive rate differentials because the Fed was either hiking while other central banks were on pause, or they were hiking a lot faster than these other central banks, which over the short term moves the needle. Now, over the long term, I don't think that's what drives currencies in relation to one another. Obviously, there's thousands of factors, but I think a bigger factor that we're seeing right now, and possibly this move just over the last, call it, month or two, from 100 straight up to 107, which is a big move. 7% move in the dollar is big. But I think this more so has to do with risk off, a flight to safety, if you will, and not just with the United States economy, but when you look at economies outside of the United States, economies like China, Europe, Germany, UK, Canada, etc. I mean, for Americans, we've had to deal with just massive consumer price inflation over the past, call it 4 years. So it's tough to argue to an American that, we're likely going to experience disinflation because of a recession or whatever. It's hard for Americans to get their head around the fact that prices might be going up at a slower clip. Understandably so. I'm not blaming them. It's like PTSD from the last, call it 4 years of stimmies and the central planners locking everyone in a cage and shutting down global economic supply chains, creating those supply chain disruptions, which led to or contributed to the big price moves higher that we have seen and that most Americans had to suffer through because their paychecks didn't go up at the same rate. But regardless, it's a much easier sell, I think, to Americans that China might be going through a disinflationary or maybe even a deflationary bust. This may happen in Europe. This has happened in Japan for the last 4 decades or 3 decades. It might happen in Germany. It might happen in Canada. It's a much easier sell there. So then once we use that as our starting point, we got to ask ourselves, okay, can the United States refrain from going down the same path if the global economy is contracting? I mean, I'll let you be the judge. It's not a 0 probability, but it's a low probability in my view. Take it for what it's worth. So my point there is it's not just, well, okay, the Fed can stay higher for longer, and we've got the Swiss National Bank cutting, we've got the Canadian Central Bank cutting, we've got the ECB cutting, we've got the Bank of England most likely cutting because I believe they've had 2 quarters of negative GDP, so a technical recession there in the UK. When that's the narrative outside of the United States, when you look at the narrative inside of the United States, it's a complete opposite, right? It's a reacceleration of consumer prices, a reacceleration of inflation, and therefore the Fed's going to stay higher for longer, right? And we can see that with SOFR futures, the SOFR future curve. We can see that with the Fed dot plot, and we can see that with Fed Watch, which is that CME kind of probabilities meter for where the Fed funds rate is going to be over the short term and looking out like a year and a half, 2 years. So let's, I'm going to save, we're going to look at the CME and what they're predicting as far as Fed funds, but we're going to hold off and save that for the next part of this video, for the next topic where we dive into that much deeper. So let's rewind, focus on the dollar. Okay, now that you know it's at 107, now that you know that this is very high, relatively speaking, and actually let me go back further than 3 years, because I'm not really doing it justice here. Let's go back. How far do we go here? All. So we're taking it way back to the late 1980s. What I really want to focus on is the time frame in which a lot of this debt was generated, and therefore they got to roll it over. And we're looking at dollar in the 80s, 90s. So just think about this for a moment. Assume you take out a mortgage and you have an adjustable rate loan. And let's just say your mortgage payment to begin with is $2,000. And that's something you can swing. And you say to yourself, okay, what are the probabilities this mortgage increases? What are the probabilities that interest rates increase to where it would impact my mortgage or my monthly payment, assuming that it adjusts in, let's say, 2 years? You say, well, I don't know, it might go up 5%. And if it goes up 5%, well, that's probably something I can still swing. So the problem here is, what if it goes up 20%? What if it goes up 30%? And at the same time, your mortgage payment is going up, but let's just assume for a moment the cost of the food you buy is going up. Your energy costs are going up. Everything you are buying is going up by, let's just say 20 or 30%, except for your paycheck. Now how you doing? Well, now you got problems, right? And it might get to the point where that mortgage payment is your number one priority. You got a wife, you got kids. It's up to you to put a roof over their head. So if you have a tight month because of all these price increases while you're not getting a raise, you may come to the decision, or you may come to the point where you've got to decide, like, this month I can't swing my mortgage payment. What do I do? Well, I've got to sell some assets, right? Maybe I have some stocks. Maybe I have some Bitcoin. Maybe I have some gold. But you say, I don't have a choice. I've got to make that mortgage payment. That's priority number one. So you start selling assets as a result. Okay, for most Americans, that makes sense. Like, you get it. But now let's take that concept and apply it to a country like Japan, because it's the exact same thing. But when I sit here and say that the dollar going up and up and up and up could be the wrecking ball for the global economy, it's not as easy for people to get their head around that, because it sounds very esoteric and kind of abstract. But it's literally the exact same thing as the example we just went over, where your mortgage payment goes up by 20%, but literally every single thing that you have to buy goes up by 20% as well. Let's think this through. First, I want to go, what's over to our next, okay, we're going to go over this next. The dollar has been on a roll and is just getting another boost after fall in UK GDP. We talked about that earlier, where I believe they've had 2 consecutive quarters of negative real GDP. We're going to get into that in a moment. I thought I had a chart of Japan pulled up. Let's go to that real quick here. So we're going to go Japan dollar-denominated debt. Hopefully we get something just to quickly illustrate the point. Cumulative flows. No, that's not it. Negative rates. No, that's not it. Foreign FX exchange. Well, let's just This isn't an exact chart, but let's just go to this for the sake of kind of giving you a visual and how this impacts the global economy. Because that's, most people, most Americans, they, and I heard this at the New Orleans Investment Conference constantly. They're like, well, what do I care what the dollar does against the yen? Well, what do I care about what the dollar does against another stupid fiat currency? So what? It's the cleanest dirty shirt in the laundry hamper. What they don't understand is there is literally nothing more important than what the dollar is doing with other currencies in terms of gold, in terms of Bitcoin, in terms of the S&P 500, in terms of global liquidity. Nothing impacts that to the degree to which the dollar versus the yen euro, as an example, impacts those asset classes. So as an example, let's just say the dollar goes up to 140. What happens to gold? Tanks, I can assure you. Maybe not long term, but in the short term. Why? Because it goes back to our example, the guy can't make the mortgage payment, so he's got to sell something on his balance sheet. So what's he going to sell? Well, gold. That's an option. So you get all these people having to sell their gold to get the dollars they need to make that mortgage payment. You see? This is why, or one of the big reasons, why the dollar going up to the degree to which it is, or it may in 2025, especially with tariffs and all these other things we got going on, dollar goes to 120, 130, and there's no way the global economy can handle that. And like I said, that will impact the prices of all of their assets, the stuff that you guys likely own right now in your portfolio. But let's get back to Japan and this example. Here we go. Let's see if I can zoom in. So this is public-private debt totals as a percentage of GDP. Now, obviously, all of this is not denominated in dollars. But for a moment, but a good percentage is, right? Especially non-financial corporations. Because if you are a non-financial corporation, you're creating widgets like Toyota, great example, right? What are the components that go into making that car? Commodities, right? Well, if Toyota wants to buy those commodities, guess what they need? Yen? No. Gold? No. They need dollars. They got to have dollars. So think about that. Fortunately for Toyota, a large portion of their income revenue is going to be dollars, but a large portion of their income is going to be yen as well, because they're selling into the domestic economy. So when they take those yen in the domestic economy, assuming they don't have enough dollars due to foreign sales, then they've got to convert the yen to the dollar, but they don't get as many dollars for the yen. See, this is exactly like the household where their input costs, food, utilities, health insurance, are going up. It's consuming more of their gross revenue. If we want to use the terms that would be applicable to Toyota, right? And if we want to use for Toyota, if we want to use terms that would be applicable to the household, their paycheck is more of Toyota's paycheck is being consumed by those commodities that they need for the input for future cars that they need to build. And that means less and less and less of Toyota's paycheck is left for profit, R&D, etc., or even to pay down debt, right? And remember, a lot of their debt, Toyota's, is going to be denominated in dollars. Why? Because they want to reduce FX risk as much as they possibly can. And so if they're needing dollars to buy those commodities, a lot of times they'll borrow dollars so that liability, future liability, is denominated in dollars. They take the dollars, keep them, and buy the commodities they need. No FX risk there because both are denominated in dollars, right? And then they're assuming that they're going to have enough dollars coming in due to foreign sales in order to cover their debt payment. Or they're rolling the dice, assuming that the yen is going to stay consistent with the dollar or maybe even appreciate to where their yen revenues are going to be able to pay down their dollar-denominated debt once they make that FX exchange, right? They take the yen, turn them into dollars. But what happens is if the dollar goes up against the yen, The global economy slows down. Now they have fewer dollars coming in, and they have to sell more and more and more and more of the yen in order to get the dollars they need, not only for their input costs, again, using an example of a household, the stuff that they need, utilities, health insurance, gas, energy. In terms of Toyota, it's commodities to build the trucks or the cars, right? So their input costs going up, while at the same time, their debt payments are going up because the dollar is appreciating against the yen. This is the key. This is the key. And it's at the sake of just beating a dead horse here. I know I talk about this on the channel all the time, but it's absolutely crucial that you guys understand how this stuff works. And you understand that the number one thing you should be focused on if you want to understand global macro, and if you want to understand, what's likely to happen to your portfolio, regardless of what assets you own, you got to focus on the DXY. You got to focus on yen versus dollar, euro versus dollar, Canadian dollar versus dollar, etc. Right? Because if Toyota gets into a pinch, again, what are they doing? They're selling the assets on their balance sheet. And that's likely going to make the dollar go even higher, assuming that they've got yen cash on their balance sheet. Or let's just say they've got gold. They're going to be dumping that gold as quickly as they possibly can, because their number one priority is paying that debt and then having enough dollars to cover the input costs for the commodities they need to build the trucks or cars that are denominated in the USD. Okay, so hopefully that makes sense. That's why dollar at 107. Okay, we're getting a little tight in the collar, right? It's just like your expenses going up by 10%, even though your paycheck doesn't go up. You can swing that for a while, because at the end of the month you had a little bit of a buffer before, but pretty soon that dog don't hunt. And if your expenses go up by 20 or 30%, now you got big problems. That would be the equivalent of the dollar going to, call it 110, 115, 120. At a certain point, I've said this many, many times, I think the United States would actually, like the Fed, would have to step in and do like some sort of Plaza Accord 2.0 to bring down the value of the dollar. And even if it would be inflationary for the United States, because the alternative is even worse. Let's just completely wipe out, destroy all of our trading partners. Okay, well, that doesn't work very well. We've seen this throughout human history, where you get interconnected supply chains, and one of those components is taken out, and it's like the Jenga puzzle. It all crashes down. Now let's go over to this Market Watch article here, talking about specifically what's happening in the UK and how this is impacting the dollar versus the pound. US dollar got another boost on Friday thanks to weaker than expected UK economic growth data that sent typo there. Come on, guys. The British pound tumbling. The UK economy contracted by 0.1% in October against consensus calling for growth, according to economists polled by Fact Sheet after the 0.1% drop in September as well. So they've had 2 months of back-to-back. So I thought it was 2 quarters. Maybe I misspoke. I apologize. 2 months of back-to-back negative real GDP, which makes the probability of them having back-to-back quarters of negative GDP extremely high. They said, while these figures are disappointing, we have put in place policies to deliver long-term growth. Oh, come on. Remember, the socialists over in the UK are the ones running the ship right now, right? And you're sitting there telling me that your socialist policies are going to deliver long-term economic growth? Show me the government that has delivered long-term economic growth. And no matter what example you give me, my rebuttal will be, that ain't the government. That's the private sector. All the government did is just got out of the way to the degree to which allowed the private sector to do what they do well and create long-term economic growth. The government doesn't produce anything. Zero. The only thing the government can do to increase productivity is to get the hell out of the way. And if you got a socialist in charge, they're going to do the opposite of that. They're not going to get the hell out of the way. They're going to become more and more and more intrusive. Well, that is the opposite of what you would need to do if you actually wanted to achieve long-term economic growth. We've got to call them out on this nonsense. So what's going on in the market right now with the dollar is they're looking at a potential recession in the UK and saying, wow, this means the Bank of England is likely going to have to cut rates. And therefore, if we juxtapose that to the narrative in the United States, higher for longer, then you get that interest rate differential, which creates this tailwind for the dollar on top of the flight to safety tailwind we talked about at the beginning of the video. See, I'm painting the picture for you to help you understand how the dollar goes from 100 to 105 to 107 and possibly to 110, 120, even higher. So we talked about this earlier, but these global central banks are cutting rates rapidly. And I know it's very easy to get in this United States focused bubble. I mean, at the end of the day, we're Americans. That's what we care most about. But we have to realize we are part of a globally connected economy. And what happens across the pond is likely to happen in the United States. And at the very least, it's definitely going to impact what is happening in the United States. Even if we're able to achieve growth, it would be lower than it otherwise would be if the Eurozone, as an example, or even China was running on all 8 cylinders. So getting back to this, we've got the Swiss National Bank cutting by 50. We've got the Bank of England increasing chances. They're cutting by even more than the market had thought. We've got the Canadian Central Bank that just cut by 100 basis points. They did back-to-back 50s. That caught the market off guard. And by the way, their unemployment rate has spiked from 5% all the way up to 6.8%. I want to talk about triggering the Somme rule, for heaven's sakes. So Morgan Stanley recently warned, though, the bulk of good news for the dollar with regards to gains from Trump administration have been priced in, and it's time to sell the greenback. Okay, well, maybe it has had a big run, and it's likely to pull back. Nothing goes up in a straight line. But I'll just save this for the next story here. My base case is we look out 6 months, and dollar's likely going to be higher due to, at the very least, the flight to safety component of what has driven it over the last, call it, couple months from 100 up to 107. Not the only variable, but that's playing a big role. Okay, now let's go ahead and address another topic, or let's look at this dollar from a slightly different angle. I want to pull up this story, talk about the dollar strength hitting some companies, some U.S. companies, and here's why and what to watch. So I don't know why they changed the title on this, because the title was how this might be a negative drag on the stock market. Where they're going with this is you have all these multinational companies that are exporting to, let's just say, China, Malaysia, Australia, wherever. And we look at the United States as having a massive budget deficit, which is true. But that doesn't mean that we don't export anything. We export a lot. In fact, the last time I checked, we export, what was it, 600 billion a month? Something like that. So that's a big number. So the key component, key takeaway here to this story, talking about the dollar, is how this impacts domestic firms that are selling overseas from a standpoint of if they're charging, let's say, $1 for their widget and they're sending it to Japan. Let's just keep using them as an example, right? Then what happens is that dollar now, instead of needing 2 yen to buy the dollar, you need 3. So effectively, what that does is that increases the price of that widget from 2 yen up to 3. Right? Consumer price inflation over there, even though we haven't increased the price. So if you have the price going up by 30, 40%, whatever it is, then what is that likely going to do to demand for those widgets? It's going to decrease, which means the sales for that domestic corporation go down as well, which, to their point, would be a negative drag on their share price. This is what they're getting at, right? But what I want to focus on is another angle for how this could impact asset classes, because this is the biggest kind of gap, I think, in people's thinking. And I'm not blaming them for it. It's only natural. There's so many moving parts here. To sit there and try to think through or even acknowledge how important dollar yen is for the price of gold, it's like, what? Like, it just seems like a concept from right field. It seems like it just shouldn't matter at all. When in reality, like I said earlier, it matters a lot. Maybe even it matters more than anything else, right? So why? Well, let's think this through in terms of China. And I don't have this pulled up, but let me see if I can find the story. I'm sure you've all heard how China is just dumping treasuries. But you have to ask why. Is it because they hate the United States? Is it because they hate the dollar? Or is it because they don't have enough dollars? You see, most people, the narrative, and you even hear this on CNBC, is that, oh, China hates dollars now. They hate treasuries, and therefore they're dumping all of them. Yeah, I don't think so. Again, let's just think about what's happening right now in China. So they are going through something that would be the equivalent of our GFC. And I'm not using hyperbole. That is the absolute fact. If you want some proof on that, what we can do is we can just look at the largest asset class in the entire world, which is Chinese real estate. That was $60 trillion as of 2 years ago, down 30%. So what does that mean? Well, let's look at that through the lens of the average household in China. 70% of household net worth, in other words, potential purchasing power, is in real estate. So if you have a 30% clip off 60 trillion, you just decreased potential purchasing power by $20 trillion. $20 trillion gone. And think about how big of a percentage that is as far as the average balance sheet in China, if that real estate component is 70%. I mean, that is a massive haircut. Think about what that does to aggregate demand, right? Think about what that does to Chinese banks, right? Think about what that does to all these Chinese banks that have a lot of dollar-denominated debt. Where are they going to get the dollars to pay back these loans? And if they want to restart the economy, they need to spend money. Well, what are they going to spend money on? Commodities. Great. You're going to pay for that in yen or yuan? You're going to pay for that in gold? You're going to pay for that in dollars, whether we like it or not. So looking at this through the lens of an average household, during the GFC, if they were selling, let's just say, assets in order to cover their rent, you wouldn't say that they're selling assets because they hate the dollar. You wouldn't say, oh, well, my goodness, they want to stick it to Joe Biden, or they want to stick it to the United States. They want to stick it to Donald Trump. So they're dumping all of their real estate. No, if they're dumping their assets during the GFC, you would say, holy cow, this means they are in trouble. So in my view, it's the exact same thing with China right now. The reason they're selling treasuries is because they have to. It's not because they want to. And taking this back to the strength of the dollar, guess what happens to that burden of acquiring the dollars if the dollar is increasing in value relative to the yuan that you can actually print or that you can actually tax? the exact same concept. It's the exact same phenomenon. So you see how everything that happens in the global economy leads to a high probability of the dollar going higher, which exacerbates this problem until, the Fed steps in and possibly does a Plaza Accord 2.0. So that's how the dynamics work there. That's the concept. And one of the main takeaways there, I'd encourage you to kind of add to your toolkit is when you see China dumping treasuries, you can come to your own conclusions, but at least consider the possibility they're dumping treasuries, again, not because they want to, but because they have to, because they are in dire economic straits. Okay, Josh, let's see if he's on there. You got anything to add, buddy?
No, I've been walking through security at the airport.
Oh my goodness gracious. Okay, well, I'm glad I'm not you, my friend. But it would be nice if you were there with Doug Casey, just for the sheer comedic value.
Watching him pat down.
All right. Well, let's get on to the next story. Guys, we got a lot of people on the live stream. Thanks for hanging out with me today. Looks like this might be a good time to do these things. Maybe you guys are off work. Let me know in the chat if this is a good time for you guys, for me to do these live streams, for you to tune in. Okay, let's just transition to the next story that I wanted to discuss. And this takes us back to talking about the Fed interest rates at the front end of the curve and what they're likely going to do into 2025 and why. And remember, when we're thinking about placing bets or we're thinking about investing, where the magic happens is when you're actually able to differentiate expectations from probabilities. And the edge or the opportunity is the delta between the two. So let me give you an example. If the market is pricing in, let's just say the Fed taking rates down to 4%, if they're pricing that in at a 20% probability, but you have an edge and you realize that the odds of them taking it down to 4% or even lower are not 20%, they're 50%. Okay, now that doesn't mean that's a certainty. It just means that the market that just means there's a spread between market expectations and actual probabilities. And again, that spread is your opportunity. Because if probabilities are exactly aligned with market expectations, there's no edge, there's no opportunity. So this is really what we have to focus on. And that's why I wanted to bring this story to your attention. So let's go over, this was a Market Watch story. So this Wall Street firm nailed its Fed forecast this year. Now it's expecting a surprise, and the opportunity, the delta between expectations, probabilities, a surprise in 2025. So this is Citigroup. Their economic team says Fed will cut rates down to the range of 3%. This is a bold call. Now, for me, it's not really a bold call, but for one of these Wall Street banks, I think it is. Why? Because let's look at expectations. We're going to go over to CME Group, Fed Watch. And if we, let's see, let's go out to December 2025. And there we go. So December 2025, the market right now, and I believe this is off SOFR futures. We'd have to look at how they calculate this, but I believe the majority is SOFR futures here. But regardless, they're saying that the highest outcome or the odds are with interest rates, Fed funds overnight being between 3.5 and 3.75. So that range. So we're basically Fed funds at 3.5. Okay, well, for Citi to come out and say, yeah, we don't think it's going to be 3.5, we think it's going to be 3. That 50 basis points, that's a lot. Because you've got to look at it from the standpoint of these Wall Street firms, and that they can't be too far offsides. Even if they believe the Fed's going to drop down to 0, let's say, they couldn't come out and say that. It's just too extreme. It's just too far from the herd. So they've got to look at the herd and say, okay, where can we be so even if we're wrong, we don't look like fools, but if we're right, we look like geniuses, but we're not taking too much risk, right? Because let's just assume that the expectations are 3.5, they're at 3, and it comes in at 2. They're still going to look like geniuses, right? But if it comes in at 3.25 and they're at 3, they still actually look pretty good because it's below expectations. Or if it comes in at 3.5 and they're at 3, they're not going to lose too much business there. But if it goes down to 0, then they look like heroes, but they don't look that much better than if it just goes down to 2.5. So there's really no incentive for them to diverge from consensus more than, let's just say, the 50 basis points, even if this wasn't their true number. So when you're reading these stories, you've got to look at it through that lens. So big economic story for 2024, at least as far as markets was concerned, was the recession never happened. I mean, I think it's too early to. Again, I love how they say that with such confidence when the NBER always says that we are in a recession a year later. I mean, okay, but let's just give them the benefit of the doubt here. The U.S. economy for a third straight year is going to grow at least by 2.5%. Okay, but that's before revisions, guys. But anyway, Citi's economic team led by Andrew Holenhorst admits their forecast for an outright contraction in the U.S. economy was entirely wrong. Our major mistake was to underestimate the extent which rising net worth of high-income individuals and easy financial conditions for large corporations would continue to drive activity. So just based on this quote, I don't know who this Andrew Holenhorst is, but he sounds like he's sharp, because these are some what I believe are really good insights, and again, off consensus. They're a little, well, I would put them in the category of being a rebel capitalist, because you're not really Alex Jones right there. You're not putting on the tinfoil hat, but to come out and say that the main reason the U.S. economy has done well is strictly because we're in all these asset bubbles, and we've had the 1% consumer driving pretty much aggregate demand for everyone else. I mean, that's almost like a conspiracy theory if you're on Wall Street, especially one of these big banks. So for him to come out and say that, which I think he's spot on, props. Let's give him a hat tip there. All right, now I want to touch on how we have a U.S. economy that's pretty much entirely propped up by asset prices and the stock market housing prices. But we're going to get to that in just a moment. So let's get back to the article here. So the Market Watch is pointing out how Andrew and his team, got it wrong. They're expecting a recession. They underestimated we'll call it the bubble economy, as my buddy Peter Schiff, I think, accurately describes it. But they did get their other calls right, accurately forecasting stubborn high inflation, 100 basis points of Fed easing. I would be very curious how they squared that circle, right? Because they were talking about 100 basis points of Fed easing, which they nailed, but they're also talking about stubbornly high inflation. You're talking about stubbornly high inflation. Why would you assume the Fed would cut by 100, other than if you thought we would have short-term inflation, and then while the economic data was weakening, and that would drive the Fed to cut by 100 when all else being equal, you would assume that they wouldn't cut at all if inflation was stubbornly high. So leading the team to give itself a B. Okay, now they're laying out their view for 2025, and the view is not pretty. They expect companies to shift from reducing hiring to outright layoffs, which I would add is typical. Every single time you see one of these cycles, you don't go from hiring a zillion people a month to just firing everybody. You go from hiring to stop hiring, then you go to the layoffs and the firing. There's a transition there. And they say this in turn will pull back the consumer, impact aggregate demand, impact investment from businesses. They say even if they're wrong about the layoffs, and I think that they've got the economic data on their side when you look at the unemployment rate and the SOM rule, and especially if you look at the differential between the household survey and the establishment survey, along with what I don't really think is a conspiracy theory, but many people might, that prior to the election, they were cooking the books, trying to make the unemployment rate or the jobs market look a lot better than it seemed to give Kamala the highest chance of winning that they could. And now all of a sudden, that's off the table. And now we got the guy, Orange Man bad in office. We hate this guy. And therefore, let's just go ahead and start reporting the numbers as without the sharpening of the pencil, let's say. And without the sharpening of the pencil and without that eraser, we might go into a mode here or a phase where the jobs market starts looking a lot like the household survey and a lot less like the establishment survey. Or maybe said a better way, the establishment survey looks a lot more like what we've seen out of the household survey, and the establishment survey looks a lot more like the huge revisions we got like 2 months prior to the election. Let's not forget that prior to the election, they revised down the trailing 12 months by like 818,000 jobs. I mean, that is massive. That is massive. And all of a sudden, just people magically forgot like 3 weeks later. It's just out of the news cycle. Okay, getting back to the article. They say the Fed will lead to, this will lead to aggressive action by the Federal Reserve, forecasting quarter-point interest rate cuts at every meeting until July to bring the Fed funds rate down to 3%. That's far lower than market expectations. Now, I want to hit the pause button here and go over a chart that I've gone over quite a bit, but I think it's very important we think through how things played out in the last cycle. It's not to say that this current cycle will play out the exact same way, but we have to understand that it's very possible, right? Because if you don't study history, as an example, right now, and all you do is just watch CNBC, it would be very easy for you to come to the conclusion that it's impossible for the Fed to drop rates next year because we have sticky inflation. The CPI has gone from 2.4 to 2.7. We have producer prices, sticky, right? And look, we've got the 10-year Treasury going up. And look, we've got the dollar going up. Things that would suggest the Fed is going to be higher for longer. They might not even cut rates. See, that would absolutely be your base case if you had no ability to study history and you made your decision based strictly on the narrative you hear right now. But if we can determine that this exact same narrative played out during the last cycle, and looking back in the rearview mirror, we know that last cycle ended with a massive deflationary bust in asset prices, which led to a quarter of actual deflation in the United States. And I would say at the very least, significant disinflation, which prompted the Fed to stay higher for longer. No. It prompted the Fed to take rates down to 0% and start QE 1, 2, 3, 4, And now we're basically on QE infinity. So let's take a moment and go back to this chart. This long-term trends, one of my favorites. And we're going to look at, let's look at CPI. Yeah, let's zoom in on the last cycle. So we're going to go 2007 or so. Yeah, let's do that. And then we're going to bring this into hopefully 2009, roughly. There we go. And let's just expand this front end out a little further. Okay. So this red line is the CPI. And when we were in September, I'm sorry, I'm way. I was at the beginning of 06. What am I doing there? Sorry, guys. Let me zoom in a little bit further on the front end, because what we're trying to do here is we're trying to look specifically at their cutting cycle that started in September of 07, where like today or like 2024, they've dropped by, you guys know it, 50 basis points. And eerily enough, they not only dropped by 50, but they dropped from, you guys know this as well, 5.25%, the exact same Fed funds rate that we had in 2024 when they took it down by the 50 basis points. And by the way, if you want to make it even more kind of eerie, is what have we had in 2024? We've had a 50 basis point cut, followed by a 25 basis point cut, followed by what we'll likely see this week, another 25 basis point cut going into the end of the year. Hence that story talking about the Fed dropping by 100 basis points. What do you think happened in 2007? Bingo. The exact same thing. Not only did we drop by 50 basis points September 18th, exact same date, but we dropped from 5.25%, exact same starting Fed funds. Then we dropped by 50 the first time. I'm talking about 2007 and 2024. Then we did a 25. Then we did a 25. It has played out exactly like it played out in 2007. Now, I know a lot of you right about now are saying to yourself, oh, whoa, time out, George. I think you're getting over your skis here, my friend. Because now we have sticky inflation. And therefore, I mean, that's nothing like 2007. That's nothing like 2008. Duh. Okay, well, let's just look at the actual data instead of guessing about it. So you can see right here where July 2007. So remember, we're not cutting for a couple months here. We're at 1.97, so 2%, 2% CPI. Now, if we fast forward to September, and come on, red line, let's highlight here. We are at 3.5. 3.5 when the Fed started to cut rates. Remember, 50 basis points, exact same thing we see in 2024. Now, what do you think happened? Do you think that we just had massive disinflation where the CPI just went straight down because we had the GFC and we went into a recession in 2008? Absolutely not. From September 07 to June of 2008, headline CPI went from 3.5 to 5.6. 3.5 to 5.6. That would be like the equivalent of the CPI going from what we had, just a month ago or so at 2.5 and going all the way up to 4.5. So just think about what the narrative would be. I mean, look, we've gone from 2.5 to 2.7. And all of a sudden, oh my gosh, it's the 1970s. We've got a reacceleration of inflation. Inflation's sticky. The Fed cut too much. They're going to have to pause. We're going to be higher for longer. In fact, they're going to have to start increasing interest rates again. This is what we're hearing. And we've only had the CPI go from 2.4 to 2.7. Hey, let's just put that in context for a moment, right? Now, I get it. The CPI understates real inflation, but we're just using that CPI as a proxy for trend. And whether we like it or not, the market is going to trade off that headline number, okay? And even if you think that it understates it, which I would completely agree, we're still comparing apples to apples because the formula they use for the CPI, as flawed as it may be, to my knowledge, is the same today as it was during the GFC. Now, once we get back to the 90s and 80s and 70s, much, much different, right? But I think that they're using the exact same methodology today that they used, call it in 2007, 2008. So it is an apples to apples comparison, right? So again, just think if the CNBC types and the talking heads and FinTwit are completely losing their mind and saying that we're just going straight back into the 1970s or we're going straight into Weimar Germany because we've gone from 2.4 to 2.7. Think about what they would do and what they would be saying if we went from 2.4 to 4.5, which is basically what we did during the GFC. Right? You can imagine, I mean, people would be pulling their hair out. They would be completely just losing it. That the Fed is way off sides. That the Fed has to start increasing rates immediately. And that the Fed is got this one wrong again. I mean, you guys know you guys know what the market participants would be saying. I'm preaching to the choir here. So my point is, how did that end? Did that end with hyperinflation? Did that end with, stocks being a great hedge against inflation? Did that end with the long end of the curve going parabolic? I'm talking about interest rates on the 10-year Treasury. How did that end? Well, most of you are old enough to remember that it ended with the Fed not only dropping to zero, the Fed not only doing QE, but the stock market taking a 50% haircut and the housing market taking a 50% haircut, meaning massive asset deflation. Massive, right? So, I'm not saying that although it's played out identical to 2007, that it's going to play out identical to 2008. That's not what I'm saying. What I am trying to get you guys to kind of think through here is just because the narrative is X right now, it doesn't necessarily mean that's the way it's going to play out. And history shows us a lot of different examples of it playing out the opposite and just doing a massive rug pull, right? I've read Wall Street journals from June, July, August of 2008. And it was all about the Fed increasing interest rates. It was all about this massive reacceleration of inflation. It was all about the Fed dropping way too low, and they were dropping into an economy that was overheating. And then 2 months later, they're at 0%. 2 months later, the world is coming to an end. 2 months later, or maybe more than a couple months, but a few months later, you're at literally negative 2% deflation, and the stock market's down by 40%, right? And I'd like to add what happened to gold right around there. Liquidity event, gold tanked. Now, that was your buying opportunity, but that goes back to what we're talking about on the earlier story with the dollar and how the dollar can impact your price of gold or Bitcoin or whatever it is due to the fact that people would have to sell whatever's on their balance sheet. They wouldn't have a choice, which is exactly what happened during the GFC. So the catalyst might be different, but the outcome would be the exact same thing. All right. So now that we understand kind of what we need to consider, let's go back to the article of this Wall Street firm. Okay, cool. So now they're talking about the Fed cutting more aggressively than expectations. If long-term rates fell, now I'm reading from the story here, that would help the hard-hitting housing and manufacturing sectors, but not by much. See, this is where I call BS. Now, I get it that if long-term rates fell, it would make it better than it otherwise would be. But that doesn't mean that long-term rates falling is stimulative, meaning that growth is going to accelerate just because we have these low interest rates. Because what you're doing is you're getting hyper-focused on the interest rate, and you're completely ignoring what those low interest rates tell you about the health of the underlying economy, right? Do you think there's going to be more lending with interest rates at zero and we're going into a Great Depression 2.0? Or do you think there's going to be more lending when interest rates are 5% and you've got nominal GDP growth at 7 or 8? Right? Obviously, when you got nominal GDP growth at 7 or 8. Well, how's that possible? Because interest rates are at 5% compared to 0%. You see, that's the fallacy in thinking. You get too myopic, and all the market does is focus on the interest rate, and they ignore what the interest rate tells you about economic growth or contraction, and therefore the bank's willingness to take risk, and therefore the borrower's willingness to borrow and allocate capital and put that capital to work, and the entrepreneur's willingness to take risk themselves. Okay, if the labor market evolves as we expect an upcoming sharper rise in unemployment rate, weaker consumer health would weigh against any demand boost from lower interest rates. Okay, I'll give them a pass on that because they're basically saying on net balance, you still have a decline. I think that's fair. The arrival of the new administration isn't changing their outlook very much, positively or negative. They say slowdown immigration will result in less supply of new workers, but that will be offset by declining labor demand. A 10% across the board tariff would only boost inflation by a few tenths of a percent point and wouldn't have that big of an impact on growth. Yeah, maybe. I mean, look, I've got a great kind of front row seat as to how this works because I live in a country that has massive tariffs. So they have huge tariffs on cars, as an example. I've done videos on this, but for you guys who want to check this out, I would challenge you. Just go ahead and look at, I know it's not autotrader.com right now. It's probably cars.com. And look at what a 2022 Toyota Land Cruiser, look at what that's selling for in the United States. And then go to tucaro.com. So I'll go ahead and it's tucarro.com. And it's probably .co. So .com.co. tucarro.com.co. And just do the exact, that's basically Columbia's version of cars.com. And look at the exact same car. Toyota Land Cruiser, 2022, same miles, same specs. And what do you think you're going to see? You're going to see a 50% price hike. Maybe more on what you would pay for that car in Colombia versus the United States. Why? Import taxes, tariffs, effectively. So if you want to answer the question, who's going to pay for the tariffs? Is it going to be Chinese? Is it going to be the Chinese? Is it going to be the consumer in the United States? It's not rocket science. Just look at who's absorbing that cost in countries where they have those high tariffs. And I can assure you, it ain't the car it ain't Toyota. It's the consumer. It's the consumer. So then what's interesting there is when you look at M2 and you look at bank lending, on top of that, you see that bank lending is decreasing. Therefore, likely the money supply growth is maybe even declining, at least flat, below trend for sure. And then you got to think through, even if you have prices going up over here due to tariffs, what happens to the percentage of paycheck that's allocated to the items that went up in price. And therefore, if there's a smaller portion that's able to allocate to other things, then you could have this balancing act, right? Where you've got prices going up over here, but down over here. So on net balance, if that whole basket of goods is right in front of you, you don't see that substantial price increase, that broad-based price increase, let's say. And it's definitely not going to be sustained unless you get that money supply growth. That's what we saw in the 1970s. That's why I believe the 1970s is so bad a comparison to the 2020s. Getting back to it here, off my little rant. They're not expecting any miracles on the deficit either. Yeah, I don't think anyone is. I think most people are pretty realistic about the deficit. Where I differ from most people about the deficit is whether or not it's a problem as far as interest rates. I think it's a complete and total nothing burger. It's not going to impact foreign demand for treasury. It's not going to impact treasuries just because you're issuing another $3 trillion or whatever. The market's going to absorb it. Why? Because they're just pocketing the spread. They don't care about supply. They don't care if Janet Yellen issues $3 trillion more. They definitely don't care what the CPI is in the United States. They just care about pocketing that spread. Right? I've done a lot of videos on that. Now, does it mean that the government spending is good and we don't have to pay a price? Absolutely not. Absolutely not. But the problem isn't in the treasury market, meaning that if we just take debt to GDP down from, let's say 120% down to 90, oh my gosh, all our problems are solved, because now we're under that threshold where there's going to be foreign demand for debt again. Now, I think that is a completely wrong way to look at it. And I think that way of looking at it actually gets us in a lot of trouble, because it takes our eye off the ball as far as what the real problem is, you see. And the real problem is not just foreign demand for treasuries. That's not an issue. The real problem is what that deficit, or what that debt, accumulation of debt, represents as far as the government spending. And what it represents is a distortion of the U.S. economy that lowers economic output, that makes it lower than it otherwise would be. Said another way, decreases the standard of living for the average American. Okay, getting back to this here. We're at this chart, US dollar, S&P 500, a risk off, risk on gauge. So I guess what they're doing here is they're looking at let's just call them asset classes, and determining what they're doing. And then they're trying to ask themselves, what is the market? What is this price action telling us about the market's view of what's going to happen in the economy in 2025? And this obviously is a component of their analysis that leads them to the conclusion that the Fed is going to drop by more than the market expects right now. Okay, now let's move on to another story here that kind of backs up what this forecast from Citigroup is talking about. And I think this is a story that we all can pretty much relate to, right? We're not talking about, euro dollar markets and SOFR future curves. We're talking about the dollar store, right? We're just talking about the dollar store that all of us drive by probably 2 or 3 times a day. So dollar stores are flashing a warning sign about lower income consumers. This is just from the other day, Wall Street Journal. Such businesses are reporting increasing signs of financial strain among their consumers. So I'm probably not telling you anything that you didn't already know. But what this tells us is aggregate demand decreasing. The purchasing power of the average Joe and Jane has shrunk. Even though their paycheck has gone up, it hasn't gone up with the rate of inflation since 2019, largely due to these economic distortions that we talked about from the central planners. So they're getting to the point where they're waving the white flag, right? They're tapping out. They're like, look, I have stretched my paycheck. I have stretched my credit card. I've done everything I possibly can to make ends meet. I'm driving Uber. I'm doing all these things, and I'm done. Like, I'm done. I just cannot buy the things that we used to buy. So I'm going to have to cut back. That's where the average consumer is right now. So then you've got to think through, okay, George, I agree with you. This makes sense. I see it every day when I drive by the dollar store. There are fewer cars out there, or any store, store XYZ. It caters to kind of the lower end consumer. I talk to my friends. I talk to my family members. It is absolutely true what you're saying. But then I look at GDP and I see 3%. Not bad, right? I look at the Capitol Grill, high-end restaurant, steak joint, and I see that the valet is just jam-packed with Ferraris and Mercedes and Bentleys. And I look at the gym, Lifetime Fitness, let's say, that costs $500 or whatever for a monthly membership. And it's packed. It's packed with people. And they're all driving up in their Lamborghinis and whatnot. So what's going on here? How can you have the dollar store and everything I see in my daily life screaming recession, if not worse, while I look at other parts of the economy, maybe in the better neighborhoods, and business is booming, right? I think they touched on it, or we touched on it earlier in the video, or, we got to give Schiff credit where credit is due for sure. And it's all about the bubble economy. It's all about, we'll call it a K-shaped recovery, where you've got to compartmentalize the economy as far as aggregate demand into two buckets. You've got one, people who own assets. You've got two, people who don't. And what has happened is the people that own these assets, they're the ones that are doing all of the spending that's keeping the economy from tanking. This is my view, right? It makes the most sense to me. And so when we step back and say, well, wait a minute here. Okay, that's kept us afloat for the last few years. Great. And the Citigroup guy, I think his name was Andrew. Remember, he was talking about this as well. But you have to ask yourself, is that sustainable? And how does that work? And then what does that do to the psychology of the average American? And does that make this inverted pyramid, so to speak, even more fragile than it was before? We're building our economic foundation on a foundation of not just sand, but a foundation of Jenga. That's what we're talking about right here. Okay, so that said, I want to point out some other stories. Let's go to right here. So we're at a crossroads right now that I think is fascinating, and it pertains to exactly what we're talking about with this K-shaped recovery and asset prices being the only thing that's really propping up aggregate demand in an economy that's 70% consumption. And then asking yourself how sustainable that is. And does rubber meet the road in 2025, or does this game of musical chairs continue to play on? Right? Those are the questions that at least I'm asking myself. So look at these headlines. I'm not going to click on the actual articles. And editor, for tomorrow, you can go ahead and just, what I'm Googling here is survey pessimism job market. CNN, Americans are fretting over job market. Yahoo, Americans grow more pessimistic about job market. Science Direct, can workers increase pessimism about the labor market? Pessimism runs rampant about the job market. Americans' confidence they'll find a job is dropping. Unemployment confidence tumbles back into pessimism. LinkedIn, job market pessimism is a little old. Or no, I'm sorry. Forget that. That's way back to 2022. Google, come on. I don't want to go off on a tangent here, but Google, really? Really? How many employees do you have? What do you have, 50,000 employees? You have one job. One. It's just give me good search results. That's all you have to do. And you're sitting here giving me search results from 2022? Like, come on. What? Why? Like can't you get somebody on this? Is there not one person out of the 50,000 that you employ that can actually make your search engine less shitty? Pardon my French. But my goodness gracious, you want to lose market share to Perplexity or AI, just keep doing what you're doing here. My goodness gracious. Talk about just getting fat and lazy. Look at this. I'm typing on all, and we're getting search results from 2022. And obviously, I'm looking at, I'm trying to uncover what is more recent in the data. Anyway, you guys get my point here. So job market pessimism at maybe not an all-time low, but going down, or excuse me, the pessimism is going up and up and up. So the average American's view of the job market, down, down, down. But what's fascinating is when you talk to them, you know, in these surveys, like well, we'll get to it in a minute here. It's the conference board, yeah. When you're looking at that survey, they're saying that overall, as far as their, let's just say the key talking point here, I think they articulate it well. Some already making strides to better their standing. Okay, they're talking more, overall households are feeling more optimistic about their financial future. So you see, this implies that they're more optimistic about the economy, but you would be wrong. See, if you scratch beneath the surface, the devil's in the details, right? And what we find is it isn't really that they're optimistic about their financial future because the economy or because the labor market is doing well, hence this Google search that I just tried. It's that the stock market is going up. Their confidence in the stock market is at all-time highs. So what they're doing is they're looking at their stock portfolio and the value of their home, and they're seeing that go up at, let's just say, a 20 or 30% clip. And then they're being asked, well, are you optimistic about your financial future? And they're saying, yeah, absolutely. When asked a more direct question, what do you think about your chances of getting a better job in 2025? And they give you the Happy Gilmore. Right? This, in my opinion, is the opposite of what it should be. We should not be basing our expectations for our financial future strictly and solely on what's happening in financial assets. In my view, it should be almost strictly and solely based on what's happening in the real economy. But we're getting to a point right now, and this is going to take us right into the next story, where people don't even care about what's happening. They don't even care about their job. They don't care about getting a promotion. They don't care about working harder. They don't care about producing more stuff. They don't care about starting a business. They only care about one thing, and that's gambling in the stock market. And obviously, I'm overgeneralizing just to kind of highlight a point. This, to me, is completely unsustainable. What happens to the U.S.? And I mean, this is a fair question and a thought experiment that I think we should all go through, which tells you a lot about the economy. Go through that thought experiment and just say, what if, for a moment, sideline, well, the Fed will step in, they'll do, Trump's going to spend $1 billion or quadrillion dollars, whatever it is, and they're not going to let the stock market. Okay, let's just shelf that for a moment. Let's just assume we had a balance sheet recession, and nothing like the Great Depression, but just a balance sheet recession like we had in 2021, where you have stocks go down by 50%. I forget the housing market for a moment, but if you really want to turbocharge the thought experiment, let's just assume the stock market, the S&P, goes down by 50%, and the housing market, let's just assume it goes down by 30. That's it. Just a correction that gets us to some level of insanity when you look at the price to income ratio. What does that do to the U.S. economy? More specifically, what does that do to aggregate demand? And just as a reminder here, wherever it was, let's go back to the dollar store. Let's go back to this story, right? Dollar stores are flashing a warning sign about lower end consumer. My point here is when you look at the distress of the poor and middle class right now, then you look at the opulence of, let's just say, the top 20%. If you have a stock market decline of 50%, along with a housing market decline of, let's say, 20 or 30, all of a sudden, what you do is you take the opulence of that top 10% and they go straight into the distress of the lower and middle class, to where everyone is in the same position, just to varying degrees. What does that do to aggregate demand? What does that do to an economy that's 70% consumption? See, now I'm not saying this is going to happen, but I am saying that the way we have structured the economy, or the central planners have, due to all these crazy incentives, we have this economy that's built on a foundation of sand, or we have this economy that's built on a Jenga puzzle, and every single quarter that we become less and less and less dependent on our job and actually producing and working hard, and more and more and more dependent on fart coin, the more pieces of that Jenga puzzle you're taking out at the bottom. And pretty soon, the game of musical chairs, or in this case, Jenga pieces, stops. Puzzle crashes. And then the 10% that are propping up the economy go into the same bucket as the poor and middle class that are struggling to the degree to which they can't even afford to go to the dollar store anymore. So again, this is not a prediction. I'm bringing this to your attention to give you an alternative view to the mainstream media, so you can factor that into your analysis and come to your own decision on what you think the probabilities of XYZ outcome in 2025. Now, that said, tomorrow or the next day, I could do a completely different video where I could argue for the stock market continuing to go up and the economy continuing to kick the can down the road throughout 2025. I can absolutely make that argument. But again, it's just about a matter of probabilities, right? Okay. Moving on. Josh, are you still with? Let me go back to the chat here. Are you still with us, buddy?
I'm here. I got to board my flight in about 5 minutes, though.
Okay. Well, do what you can on your end. And if you have to board the flight, we totally get it. You can check out, and I'll just, I'll take us home here on the live stream. And we've been going, wow, an hour and 20 minutes. Boy, my goodness gracious, I can talk. Can I? I'm like Peter Schiff 2.0. Who likes to hear themselves talk more, me or Peter Schiff? You guys let me know in the chat. All right, so let's get on to the next story, which I think really dovetails well on what we were just talking about. And that is this complete and total mania that we are seeing in not just risk taking, but more specifically in these meme coins and in NFTs, cryptos. And I would, exclude Bitcoin, although you get a little bit of a bump there with Bitcoin. If you get the hysteria in the fart coins and whatnot, I think that plays into it. But the risk taking is off the charts, right? I mean, and when I talk about risk taking, I'm talking about straight gambling. Now, when I look at this, and I'm sure most of you, when you look at these meme coins, that's what comes to your mind, is gambling. Or why are these people just throwing their money away? They might as well go down to the roulette wheel. They have better odds. Or they might as well, pull the handle on the slot machine. But in reality, that's true for 90% of them. But 10%, it's not. And this is what I find absolutely fascinating. And I wanted to share these insights with you. Let's go over to my Twitter feed. And here we go. Hopefully it was a more yes, it was. Great. Okay. So Josh, can you see that?
Yes.
Best crypto plays. Now, for those of you who aren't on Twitter, they have this thing called Spaces, where you can set up a space, which is basically like an audio live stream, and people can join that live stream, and they can chime in. You can make them speakers, and it's just this big conversation that everyone can listen to. And a lot of times they'll have literally thousands of people on these live streams. Now, I've been doing this over the last week because I'm just fascinated by the psychology here. And there are a lot of insights you guys need to know. It's not just, that they're stupid over there. Oh, I'm just not going to pay any attention to Dogecoin or whatever. You really need to pay attention because this gives you, I think, this gives you a framework to better understand the risk taking that we're seeing all over the place, including in the S&P 500, the Mag 7, or whatever. Okay, so I try to log on to these crypto or meme coin spaces maybe once every other day, just 10, 15 minutes, just to get an idea of what it is they're actually talking about. And this particular space had like 2,500 people. I was on one the other day that had over 6,000 people on it. 6,000. And they all have these these hidden identities where they're using these JPEG things. Yeah, I don't blame them. Whatever. To each their own. But they're all anonymous. Nobody's using their real name, or very few people. So that leads us into the next part of the story. So, and by the way, if you're on Twitter, I would highly suggest you checking out one of these spaces when you get 10 or 15 minutes. You'll find it. Well, there's a lot of adjectives I could use. Oh, you see there. I should hide that. Those are my direct messages there. Talking to my good buddy Chris Irons from QTR. I don't want to let the cat out of the bag, but Chris and I are talking about doing something huge, a huge collaboration in 2025. Well, I don't know. It's in the discussion phase right now. But if you like my content and you like the QTR podcast, if this does pan out, you're going to love it. This is going to blow you away. But anyway, getting back to it here. Okay. Too many traditional investors, meme coins make no sense. I think that would apply to almost all 2,600 people on the live stream right now. Why on earth would someone buy fart coin? It sounds like a South Park episode. It does. I would suggest tuning in to a crypto meme NFT space. 10 minutes of hearing the banter and psychology will make it crystal clear. So here's where it gets really interesting. It's not just, these people are crazy and they're just throwing their money down the toilet. No. These spaces are occupied by individuals who, I'm going to put the ethics aside for a moment, actually do have an edge in this meme coin insanity. And here, from what I've noticed, here are some, let's just say, key talking points, right? Now, and I don't want to overgeneralize, but these are the themes that I find pervasive throughout these discussions. Number one, and this is probably not going to surprise anyone, you can't improve your lot in life via working or producing. So kind of a nihilistic view, which I don't blame them for. I'm not here to, poke fun or blame. I'm just here to give you guys insights into how these communities work and how that translates into Fartcoin being $1 billion market cap. Next key talking point here, another theme that's pervasive within these spaces. You can't get rich in the S&P with real estate or even Bitcoin. You can get rich if you buy a meme coin that is about to get pumped. Now, what's really interesting is when you go into these spaces, they're not hiding anything. I mean, I got to give them credit there. They're not trying to make it believe like there's actually a fundamental reason to buy whatever PP coin or Peppy coin or whatever. No, they're not under any illusions of grandeur. They're sitting there saying, look, we're trying to figure this out, and we're trying to figure out what coin is going to get pumped next so we can front run it. That's a lot of the conversation there. So they're not trying to fool anybody. Well, I take that back. They are trying to fool some people. We'll get into that in a moment, but you'll find that the majority of these people in the spaces are, for lack of a better word, let's just say the influencers in the space. They're the people that are that get it. They're the 10% that maybe have an edge, that are trying to work that edge to manipulate the 90%. Again, I'm not passing judgment here. I'll let you guys do that on your own. But they're trying to manipulate the 90% for what effectively are just pump and dump schemes. Next, instead of wasting your time studying the fundamentals of a business, doing like the Warren Buffett thing, that you take that same amount of time and energy and come up with a system to front run, these coin issuers that have strong pumping and dumping, maybe, track records. And then you get in good with them. Because see, if you're part of the cool kids club, then you're part of the people that are doing the manipulating. And then it's like Gordon Gekko. It's like insider information. You've got an edge. And think about it. If you're nihilistic about the real economy or your job opportunities, and you're sitting there thinking to yourself, okay, I've got 10 grand. I've got 20 grand. How do I increase the probabilities of me turning that into 2 million so I can have some hope of having a decent life? Well, I've got to get in good with the people that are issuing, and let's just be honest about it, manipulating these cryptocurrencies. I've got to get on the inside. I've got to get that insider information. I've got to play ball. And if I do, then I'm going to have that insider information required to turn that 20 grand into whatever I need to in order to have a decent life. Because it's sure not going to happen in the real economy. It's sure not going to happen as a result of me working harder, producing stuff, or getting promotions or a better job, or starting a business. In fact, most of these people, I think, would consider this their business. And when I'm talking about this, I'm talking about getting on the inside, getting that insider information, and being part of the group that is intentionally pumping and dumping these stocks. Now, how do they do it? Right? Because just someone with their Twitter account with, let's say, 1,000 followers, I mean, how much influence do they really have? See, here's where, again, I'm not passing judgment. I'm not saying this is ethical or unethical. I'm just giving you the insights. Bottom line, this is clever. This is clever. What they do, and they'll openly talk about this, they have groups that are managed by these, let's just call them influencers. They're Telegram groups or these online communities that they are kind of in a leadership role. And they'll try to, bring people into these communities and sit there and talk about whatever meme coin is the topic du jour. And they'll sit there and they'll tell these people how great it is. And then they'll basically try to recruit them to go out there and be like an army of individuals where their only intention or their only objective is to create hysteria, number one, to get the buying, and then to smash FUD, fear, uncertainty, and doubt. Because if you can, go out to the masses and join every single space you can, if you can join every single Facebook group, if you can comment on every single YouTube video or whatever it is, and then you can, not just on your own, but you can create a bot army of hundreds, maybe thousands of accounts that can do the exact same thing. So when an individual that doesn't know how the game is played, when they go onto Twitter, they see all these people following, or they join a community, they don't realize it's 2,000 bots and just 3 or 4 dudes that are controlling those bots. They think it's literally 3,000 people or whatever it is that are all wildly bullish on Peppy coin, right? So then that person unknowingly is being manipulated, and they're like, wow, maybe, holy cow, maybe I should be bullish on PP coin. And then they go out and buy Peppy coin, and then let's just say the price starts to go down slightly. And then they go into that same community with the 3,000 bots and the 2 or 3 guys controlling it that are on the inside. And they say, I don't know, guys, what do you think I should do? The price hasn't gone down, or the price has gone down by 20% yesterday. I'm getting a little concerned. Then what the leaders do is they sick the bot army, or what's even crazier is they actually have people that you can hire that are experts at smashing FUD. So if you're, let's just say, if you've got a lot invested in XYZ shitcoin and you're trying to pump it, and you've got this, 5,000 individual bot army, and you're just sicking those bots on every single community that you possibly can to generate this hysteria for this coin that you bought, way back when it was nothing and nobody knew about it. And you're trying to do everything in your power to pump the price and to not only create that frenzy, that mania, but you're also making sure that people don't sell, right? You got to smash that FUD. So let's say that you've got a coin that you bought at 5 cents. It went up to $1.50, and now it's down to 125. And you want to bring in that second wave of pumping. But you've got a lot of people that right now are holding the bag and took the loss from $1.50 down to 125. What do you do? What do you do? Well, look, if you've got $1 million, let's say, in this XYZ meme coin, well, you're going to go out there and you're going to spend whatever. Let's just say $100,000 to hire someone that's a professional at smashing FUD. And they've got bot armies as well. So they're going to come into these communities, and when anyone mentions, I don't know, maybe I should sell, they just, boom, they get very aggressive, and they attack them. They attack them. How dare you? I'm not going to use, I've already used profanity. I'm going to try to limit the profanity, let's say. They're calling them all these names. It's basically like a frat house, right? Where you're trying to punk this person into having diamond hands. So if you're the guy that's paying that person $100,000 to do this for you, it makes sense. Because if that guy can manipulate enough communities to make sure that they don't sell, and you bring on a few more buyers, now all of a sudden the price goes to, let's say, $2. That gives you an extra 75 cents pop. And if you own a zillion shares, then that's, let's just say, an extra 500,000 when your initial investment was 100. It makes sense all day long. But what you have to realize is the majority of these individuals that are commenting on how great this coin is, or how it's the future, or how crypto is going to take over, most of them are bots that are just programmed. I don't know how they do it, right? But when you say X, they're programmed to say Y as a rebuttal. And then you've got the professionals that come in and that just bam. And what's great, or where you can see this in real time, is if you just watch my Twitter feed. In fact, let's go, let's see here. I'll bet you if I just click on this, there's going to be some comments from these people that you can tell are either a bot or they're a professional FUD smasher, right? And I'm sure I'm on their radar, right? So if George Gammon says anything negative about PP coin, we need to attack immediately to make sure that none of his followers or all of his followers know how stupid he is for attacking PP coin. And usually it's just ad hominem, because what are they going to say about PP coin? Nothing. They're just going to attack you personally, and therefore disregard anything George says. He isn't credible. And I'm not just talking about me. They do this with everybody, right? It's not just George Gammon, but I'm just using myself as an example. So let's look at the comments here and see if you guys can see this. Culture. I don't see any right here. Let's go back to the feed. See, I know I had a tweet the other day where I just got pounded by these, these FUD smasher guys. And look, I love Bitcoin. I think everyone should own it. You guys know that. But there's a lot of these people in the Bitcoin space as well. And we'll get back into that in a moment. But I'm sure that you'll find this on a Bitcoin tweet. Look, Al, I don't want to call it John. I'll go easy on him here. Let's see. So I was talking about Bitcoin being lent on a fractional reserve basis, and why I think there's a lot of reasons to buy it or own it, maybe. But the 21 million thing is not a reason, because in my view, the more popular Bitcoin becomes, the more paper Bitcoin you will have, which effectively increases the supply. So I think that's pretty much how it plays out. I'm not going to spend too much time on this. I think you guys get it. But there were a ton of people on here initially. It looks like maybe the algorithm pushes them down. The Twitter algorithm. Okay, let's get back to it here. Like I said, I would like to give you guys some examples, but I'm sure you've probably seen it yourself in the comment section or on Twitter. Okay, getting back to these key talking points here. And this is basically what I was just outlining. So we were talking about the track record of a guy that's a notorious pumper, or one of these FUD smashers, getting behind a specific coin and then getting their entire community, that includes the bag holders and the bots and everything else, to push, and knowing that guy, or knowing him well, and you're trying to front run that. Okay, so your edge is not analyzing the fundamentals of a company, but your edge is trying to analyze these capital flows that, let's just try to be as kind as we can, where the marketing is being emphasized. The marketing. Again, I'm trying to be as nice as I can. Okay, so next key talking point. This would include having Telegram groups of hundreds or thousands. We're talking about how do you decipher which coin you should buy based on who's behind it right now? Well, you want to get behind or buy the coin that has as many of these, let's just say, whales or influencers with these hundreds and thousands of fellow pumpers, bots, FUD smashers. You want to be a part of that inside group, right? Because you want to know where they're going to focus their attention next, because that's the next coin that's most likely going to moon. So I say it's basically their edge. This is the next key talking point. They can't compete in traditional investing, and maybe they don't even want to compete. Let's give them the benefit of the doubt. So they've systematized and turbocharged the traditional pump and dump. Next key talking point. Once they sell, and I thought this was really interesting, once they sell, they take the proceeds and they buy Bitcoin for a long-term hold. So to them, that's their S&P 500. And they'll sit there and say, well, you can't get rich on Bitcoin because it's only, even Saylor said it's only going to go up by 30% per annum. and they sit there and compound that like this is mouse nuts. That's the same return that I have on Fartcoin in a week. So their game is to sit there and buy Bitcoin with the proceeds from the pump and dump. And then when Bitcoin is going up, you just hang on to it. Then when it kind of goes sideways, well, then maybe you can sell a little bit of it, go back into the meme coin game, pump more, create the bot army or follow the bot armies, take your edge and apply it, get the bag holders holding the bag, and then you reinvest that back into Bitcoin and ride the next wave of the Bitcoin cycle higher. I'm not saying that's what is going to happen. I'm saying this is the way they look at it. And obviously, kind of the flaw in the logic there is they're assuming they make the broad assumption that Bitcoin, Ethereum, what's the other one that a lot of them are into? I don't know if it's XRP, but they just assume as though it was written in stone that Bitcoin will just continue to go up every single year for the next 100 years. So then I just go on to say, I'm not here to pass judgment. It's just giving insights as to how this works. So how does this play into the last story we did about the poor and middle class struggling and the economy completely propped up by asset prices? Because what we're seeing, to me, this represents another Jenga piece being pulled out of the bottom of the puzzle. From the standpoint of you guys that are a little older, you know that although this may be working right now, this this ends badly, right? This ends badly. And so when this eventually ends badly, and I know it's hard for a lot of young people, but they need to understand that the way these cycles play out over and over and over, and the way they will play out, and I don't know when, but the way they will play out. Why? Because it's based on human nature, and that doesn't change. I don't care what type of AI, internet, I don't care what type of technology you have. The hardwiring that makes us human is the exact same today as it was in the 1990s, as it was in the 1920s, as it was in the tulip mania. It's all the same, right? There's really nothing new under the sun. They've just taken these concepts and, like I said, put them on steroids. So when this ends badly and we get to a point in the cycle, which most of your older folks can remember very, very well, where people just completely swear off whatever asset class it was. So if you remember the housing market, right, for several years after we had that significant decline, what did people want to do with housing? They wanted nothing to do with it. Nothing. In fact, I remember when I first got into real estate in 2012, everyone around me was telling me that I was insane, that I was absolutely crazy for buying real estate because everybody knows that real estate always goes down. It's the same thing with the 1929 crash leading into the Great Depression. How long did it take for people to start dipping their toe back in the stock market as far as the average Joe and Jane? A long time, didn't it? That's when the bond market became very popular, extremely popular. So we go through these cycles where you get complete and total capitulation, where even the most diehard bull has now sworn off buying stocks or NVIDIA or AI or Mag 7 or meme coins or NFTs, and is never going to touch this for the rest of their life. And then it takes 2 or 3 years, it kind of maybe rebounds to whatever the next risk on asset is, the next get rich quick scheme, which at the end of the day, all this is, right? Nothing new under the sun. So my point here is this can exacerbate the decline if we go from a risk on, a massive risk on, to a capitulation and total and utter risk off. to where all of these people are no longer making millions of dollars on these pump and dumps, where they actually have to go back to working their job at FedEx, and 100% of their purchasing power just goes back to them working overtime, as opposed to them getting, let's just say, insider information and managing a bot army of 5,000 accounts. That, to me, has a significant impact, not only on aggregate demand, but probably more importantly, onto the social psyche of society at large. And how do you juxtapose that relative to what Trump is doing? I don't know. On net balance, is it a negative or a positive? I don't know. I'll let you be the judge. But I don't think the reason I wanted to go over this story is to give you guys some insights that I thought were fascinating. And it was also to really get you guys to pay attention to this. Pay attention to this phenomenon. Don't dismiss it. It's just like the dollar. Same thing. The dollar going up against the yen. Don't dismiss that. That's very, very important. And I think the dollar is more important than the fart coin, but don't dismiss don't dismiss this either, because I think it is also very, very important to include into your analysis of how this crazy, crazy world plays out going into 2025. All right, guys. Enjoy the rest of your evening. As always, make sure that you are standing up for freedom, liberty, free market capitalism. I'll see you on the next video. And by the way, let me know how you like this long live stream, different topics. Let me know in the chat. Let me know in the comments. If you like it, we'll definitely keep doing it.